Bismillahirrahmanirrahim. Assalamu alaikum to everyone. Welcome to online class of Financial Statement Analysis and Valuation. Today we are conducting our second lecture and I am your instructor Syeda Arooj. In first lecture, we talked about the overview of Financial Statement Analysis and Valuation course, where we discussed about the importance of the course and what are the practical implications of the course and the topics we are going to cover in this course and the outcome of the course and now we are properly start with the introduction to the financial statement analysis and valuation. In today's lecture we will cover what is financial statement analysis, users of financial statement analysis, the key financial statements, the balance sheet, income statement and statement of cash flows, and how financial statements are analyzed. Let's start our lecture with what is financial statement analysis. Financial statement analysis is method of reviewing and analyzing a company's accounting reports in order to gauge its past, present, and projected future performance. This performance process of reviewing the financial statement allows for better economic decision making. Globally, as you know, that public listed companies are required by law to file their financial statements with the relevant authorities. For example, publicly limited firms in Pakistan are required to submit their financial statements to the Security and Exchange Commission of Pakistan, which we call the SECP. Firms are also obligated to provide their financial statements in the annual report forms and they share with their stakeholders. Financial statements are prepared in order to meet the requirements and the second step is the process is to analyze them effectively so that the future profitability and the cash flows can be forecasted. The purpose of financial statement analysis is to utilize the information about the past performance of the company in order to predict how it will fare in the future. Another important purpose of the analysis of financial statement is to identify the potential problems area and troubleshoot those problems. So we discussed the importance of financial statement analysis earlier, but officially we can define it as that it's an information processing system designed to provide data for decision-making models such as portfolio selection model, bank lending decision models, and corporate financial management models. And we can further elaborate it that is largely a study of relationship among the various financial factors in business as disclosed by a single set of statements and a study of the trends of these factors as shown in the series of the statements. So there are when we talk about the who use financial statement analysis and what are those people behind and what are those parties that are interested in making financial statement analysis and what are their purposes. There are different users of financial statement analysis. These can be classified into internal and external users. Internal users refers to the management of the company who analyzes the financial statements in order to make the decisions related to the operations of the company, or the owners. They are also the internal to the organization, and board of directors as investor representatives use them to monitor the manager's decisions and action. Now, where there are small business owners, they need financial information from their operations to determine whether the business is profitable or not. It helps in making the decision like whether to continue the operating the business, whether to improve the business strategy, whether to give up on the business altogether. Then another group of persons are the investors. Investors who have purchased the shares in the company need financial information to know the method which used by the company in performance evaluation process. Investors use the financial statement analysis to determine what to do through their investment in the company. So depending on how the company is doing, the investor will either hold on to their shares, sell them, or buy more. So decide. Uh, so to decide such to make such decisions, investors need to analyze the financial statements. Then comes a group of creditors. Creditors are basically interested in knowing if a company will be able to pay its debt or loans as they become due. The creditors use the cash flow analysis of the company, accounting records to measure the company's liquidity or its ability to make the short-term payments. Even if they have involved in the long-term loans, then they might go for the solvency of the firm, and they analyze the financial statement for solvency. Then another group include the employees. Employees need to know if their employment is secure and if there is a possibility to increase their salaries. And employees want to be well informed of their company's profitability and stability. Employees may also be interested in knowing the company's financial position to see whether there may be a plans for expansion or hence the career prospects for them. Employees and union use the financial statement in labor negotiations, and they are including their labor laws and all such stuff. So they are interested in making analyzing the financial statement. Customers need to know about the ability of the company to service its client into the future. The need to know about the company's stability of operation is heightened. If the customer is dependent wholly on the company for its supplies, and like they are the distributing part of the firm's product. General public may also be interested in analyzing the financial statement. For example, students, analysts, researchers, they may be interested in using the company financial statement analysis, and this may wish to evaluate the effects of the firm on the environment or the economy or even the local community. So for instance, if the company is running corporate social responsibility program for improving the community, even then the public may want to aware of the future operations of the company. Then comes suppliers. A group of suppliers use the financial information as part of the due diligence process, basically. An important step in identifying the risk associated with doing business with the clientele. And suppliers use the financial statements in setting the credit terms, since if they have provided the trade credit and involving in the trade credit terms, so they need to analyze the financial statements of the firm before setting the credit terms. Others may include investment advisors or the auditors and the private audit firms, and the information intermediaries use the financial statement in making the buy and sell recommendation. In credit rating, investment bankers use the financial statement in determining company value in initial public offering, maybe, or in sort of expansion strategies like the merger, like the acquisitions. So these are certain parties or the people who are interested in making the financial statement analysis or analyzing the components of the financial statements. Students, as you know that we are more interested in analyzing the financial statements rather than preparing the financial statements. So here we will just recall the financial statement, the basic financial statements, and we will see different components that are in the basic financial statements, and we will study those components, and so that in future when we analyze the financial statements, we would be it would be easy for us to recall and remind the things that we have earlier studied and prepared. So key financial statements and their analysis The main types of the financial statements are the balance sheets, as you know, the income statement and the statement of the cash flow. And these accounting reports are analyzed in order to aid the economic decision making of a firm and also to predict the profitability and cash flows. So starting with the income statement. The purpose of an income statement is to report the revenues and expenditure of the firm over a specific period of time. And it was previously also called a profit and loss statement account. And the general structure of the income statement with the major component is as follows. For example, we have a hypothetical income statement, and which is yearly ended December 2020, and the sales revenue. This is the opening head of the income statement, and which is sales revenue, starting with the sales revenue, and then comes the cost of goods sold. This is how much cost to produce all the goods or services you sold to your customers. It involves direct expenses like raw material used for preparing these products, or the labor and the shipping cost. So when we deduct the sales revenue, when we deduct the cost of goods sold from the sales revenue, we will get the gross profit. And gross profit, it tells us about the profitability of the business after taking into account the direct cost, but before taking into account the overhead cost. We can say that gross profit is a rough estimate of firm's profitability. Then comes the general expenses, also called the operating expenses, and these include the rent, bank, ATM fee expenses, or equipment expenses, marketing, advertisement expenses, any other fees or other expenses you need to make to keep your business going. These expenses are listed individually here, but in some income statements they are accumulated in form of bundle, and similar expenses together into one broad category called the selling, general, administrative expenses. So when we deduct the all these general expenses from the gross profit, we will get the operating earnings. And operating earning is like, this is how the profitable your business is after taking into account all the internal costs, all the internal expenses, and which you have more control over, but before taking into account the external costs like loans, like the interest or payments and taxes, and which you have less control over. And accountants will sometimes call this operating profit, or operating income, operating profit, or operating income. Then comes interest expense. If your business owes someone money, and if you have borrowed a loan from the bank, and it probably has to make monthly or quarterly interest payments, and your interest expense are the total interest payment your business made to its creditors for the period covered by the income statement. Then when you deduct your interest, then we get the earning before interest figure. And finally we have to deduct the income tax expenses, and this is how much you pay tax during this particular time period for which income statement has been made. And then comes, after deducting the income tax, we will get the net profit. And this is the final and total profit, or you may call it a net income or net profit for your business. And after all the cost, all the expenses, interest and taxes are deducted from the revenue. This is again a summary of income statement heads, that sales revenue deducted cost of goods sold, then we get gross profit, then all the general administrative expenses, we get the earning before interest and taxes, depreciation, then depreciation amortization deducted, then we get the earnings before interest and taxes, then interest deducted, then earning before taxes, and then taxes deducted, and we get the net income. Net income on the income statement, if positive, it shows that the company has made a profit. And if the net income is negative, it means company incurred a loss. Now let's see that how different components of income statement help us in identifying some facts about the organization. So if we analyze the income statement and if we want to know about the profitability of the company has earned after taxes on all the expenses which have been deducted from the net sales, and we call it a net profit margin. And when we uh, divide net profit, which is the component of the income statement, with the sales revenue, which is also a beginning head of the income statement, we get the net profit margin. And then return on equity. If the net income, which is income statement component, net income, we divide it with the book value of the equity, book value, or you may say that shareholders equity, then we get the return on equity ratio. And it just calculates the company profit as a percentage of total equity. Another measure is earning per share, and this ratio can be derived from knowing the total numbers of the share outstanding of the company, net income, which is a component of the income statement, and we divide it with the number of share outstanding, and we get the earning per share. That how much per share is earned by the earning per share is earned by the shareholders. Then comes the valuation ratio. And the price to earning ratio, it is used to evaluate whether the value of the stock is proportional to the level of the earning, and it can be generated for stockholders or shareholders, and it assesses whether the stock is overvalued or undervalued. And here you can price to earning ratio can be derived by market share price divided by earning per share, which we already calculated by net income to number of share outstanding. So these are certain little examples about the components of the income statement, that how these are very helpful in analyzing and identifying the facts about the organization, and based on these facts and figures we can make decision. Now the second important statement we have is the balance sheet. Balance sheets give a snapshot of your financials at a particular moment, incorporating every journal entry since your company launched, and it shows what your business owns, like assets, and what it owes, like liabilities, and what the money is left over for the owners, shareholders equity or owners equity. So asset, liabilities, and shareholder equity are listed as a specific date, such as the end of the financial year. Companies usually prepare the one at the end of the reporting period, and that's how for yearly, usually the balance sheet is prepared for yearly statement, and it includes the asset, liabilities, and shareholder equity. As you can see in the formula, that assets is equal to liabilities plus shareholder equity. And here is an example of this sample balance sheet, where one side we have all the assets, and another side we have liabilities and shareholder equity. As you can see at the glance of this balance sheet, it reflects every transaction since your company started, and it reveals your business overall financial health. At a glance, you can see that you will get to know exactly how much money you have put in and how much debt you have accumulated on another side. Likewise, the information in your company's balance sheet, there are different components in the balance sheets, can help you calculate the key financial ratios, and which you further utilize as for making the decisions. You may also compare your company's balance sheet with your previous year's balance sheet, to get to know how the finances have changed over time, and you will be able to see just how far you have come since day one, or since you have started this business. This is balance sheet equation. You can write it in terms of the asset liabilities and stockholder equity. You can also write it in terms of total investing, which are the investment in the assets, and total is equal to creditor financing, which you have borrowed from either from the financial institution or either you have issued debt, any form of debt, or plus owner financing, which is again the stockholders or shareholder equity. Assets goes on one side and liabilities and equities go on other side, and the important point is that two sides must be balanced. Hence this is why it is called the balance sheet, and it makes sense that why we call it a balance sheet, that what you pay for your company's assets either by borrowing from financial institution or by issuing debt, or getting money from the owner's equity. That's how what you pay for your company you either get from external sources, from in form of loans or in form of issuing debt, or either you get money from the owner's equity. The major components of balance sheet, asset liabilities, and owner equity are further organized and categorized into the small chunks. Like assets are divided into the current asset and long-term assets. Assets are those things your business owns and that have a monetary value. And we categorize it into the current and a long-term asset based on the liquidity, how easily these assets are turned into cash. And anything you expect to convert into cash within the 1 year, you may call it a current asset. Current asset include money in your checking account, money in the transit, account receivable, short-term investments, inventory, prepaid expenses, and cash equivalents. When we if we talk about the long-term assets, these include the buildings and lands and all the long-term assets which when you convert it into cash, it takes more than a year, and it includes the machinery, equipment, intangible assets like the patents, trademarks, goodwill, and long-term investments. The liabilities are again categorized into the current liabilities and long-term liabilities based on their due within the year, or due date is more than, like they are payable more than 1 year or within the year. So what your business owes to other, we call it liabilities, and current liabilities account payable, what you owe supplier for items you bought on credit, then wages you owe to employees for hours they have already worked for your company, loans that you have to pay back within a year, interest and loan payable within 1 year, taxes owed, and long-term liabilities that you don't have to pay back within a year, and bonds your company has issued, all comes under the long-term liabilities. The last component is shareholder equity. Shareholder equity is also known the book value of the equity, net worth of the company. It is basically a difference between the total asset owed by the firm and the total liabilities outstanding. It is different from the market value or the equity market value of the equity, which actually the stock market capitalization, which is calculated as follows: the number of the share outstanding multiplied with the current share prices, which is the total number of shares that a firm has issued so far, multiplied with the current prices. So owner equity includes capital, money invested in the business by the owner. It comes under the head of shareholder equity. Private or public stock that they have purchased, or retain earnings if they have not that you haven't received the dividend and you reinvested into the business. Equity can also drop when the owner draws money out of the company or pay it themselves, or when the corporation issues dividend to the shareholders. Now let's have a look how the components of balance sheet help us in analyzing the health of the firm at a given point in time. Debt to equity ratio, which can be achieved by total debt divided by total equity, and the debt to equity ratio is also called the leverage ratio, It is calculated to assess the leverage of a firm, to show how much it relies on the debt to finance its activity. This ratio has pertinent implications for the financial health of the firm and the risk and return of its shares. Then comes the market to book ratio, which is a market value of equity over the book value of equity. The market to book ratio is used to reflect any change in the firm's characteristics. The variation in this ratio also show any value added to the management and its growth prospect. Then comes enterprise value, which we can get by market value of equity plus debt minus cash. And the enterprise value of the firm shows that underlying value of the business. It reflects the true value of the firm assets, not including any cash or cash equivalents, you can say that it while and unencumbered by the debt of the firm carries. The third important statement we have is the cash flow statement. And cash flow statement is concerned with the flow of the cash in and cash out of the business. The statement captures both the current operating results and accompanying changes in the balance sheet. As an analytical tool, the statement of cash flow is useful in determining the short-term viability of the company, how much cash you have on hand for a specific period, and your ability to pay the bills. Cash flow can be, here is an example of cash flow statement. Cash flow can be divided into three different portions, like cash flow from operations, cash flow from investing, and cash flow from financing. Operation activities, then investing activities, and cash flow from financing activities. Here in this statement, we can see that the information from income statement and balance sheet, there are different components from the income statement and balance sheet have been used in the cash flow statement to create the cash flow statement. For example, net income from the income statement, depreciation and account increase in account payable, account receivable information from the balance sheet. So this is how we can say that how these three statements are interlinked, and you create your cash flow statement from information from the income statement and balance sheet. Sections of the cash flow statements include three types of sections: cash flow from operating activities and or spent in course of regular basis activities, that from your operation business activities, your daily day-to-day operations. The main way your business makes the money by selling the products and producing and selling the products or services. Cash flow from investing activity is cash earned or spent from investment your companies makes, such as purchasing equipment or investing in the other companies. And from financing activity is the cash earned or spent in course of the financing your company with the loans, line of credits, and the owner's equity. There are four simple rules to remember as you create your cash flow statement, and you may be familiar with these rules, that transactions that show an increase in asset result in the decrease in cash flow. Like when your assets are increased, you might have purchased those assets, so there is a decrease in cash flow. And transactions that show that decrease in asset result in increase in cash flow, that you have sold out your assets, and in result you might have gotten the cash. And the transaction that show an increase in liability result in increase in cash flow, that when you borrow loan, you get cash, and that's how it increase in it comes under the increase in cash flow. And transactions that show a decrease in liability, that you have paid off your loan or interest, and that result in the decrease in cash flow. Now let's have a look on the cash flow statement analysis. If we want to measure or if we want to know how much cash is available to the company for investment, but and we don't want to go for the financing from outside, like borrowing loans, or even we don't want to divert our money from the operations or the earlier projects, then it is useful to measure the free cash flow, as the name suggests, that which allows a company to be able to pay its dividends, repay its debts, buy back its stock, and also make a new investment to facilitate the future growth. The excess cash that we call the free cash flow, which is left over after all these paying, we can calculate it with different formulas we have. Like if we get the information from the income statement, we can calculate the free cash flow by taking the cash flow from operating activities, which we get from the statement of the cash flow, plus interest expense, which is a component of the income statement, tax shield on interest expense, which is again from income statement, and capital expenditure, which is the cash flow from the investing activities of the cash statement of the cash flow, and we can calculate the free cash flow. If we take the component from balance sheet, we can also calculate the free cash flow, and balance sheet and income statement. We take the components from balance sheet and income statement, and earning before interest and taxes, which is located from income statement, non-cash expense, depreciation and amortization, which is taken from income statement, and change in current asset minus current liabilities, which are working capital, which is taken from the balance sheet, and then capital expenditure, which is the balance sheet component, and including the property, plant and equipment, which is comes under the head of the long-term assets, and we can also calculate the free cash flow. So class, we will discuss all these analysis from these financial statements in detail in our upcoming lecture. This is just a brief intro to what we are going to study in our course, in our upcoming lectures. And so in today's lecture, we covered the introduction to the financial statement analysis and valuation, and we talked about the uses of the financial statement analysis. We also discussed the basic financial statements, and in our next lecture, we will talk about the methods of financial statement analysis, and there are different tools that are applied for analyzing the financial statements, and we will discuss all those tools. And so for now, our today's lecture ended, and any questions and queries about this lecture, you are most welcome, and thank you.